To take a whole packet.
Yeah, note to self for next year, I will do them once the night before. So, anyway, so I want to also kind of enculturate you into teaching entrepreneurship at the GSB. This lining up these advisory sessions is kind of the highest level of spoon feeding we will go to. But each of these folks have indicated have been advisors for us for, we only have one who's brand new this time. So they're all kind of accustomed to the idea of helping with the educational process. But I also remind you guys that Pete Ziebelman was in there last night, and he's like, you realize this is totally out of the norm for venture capitalists because as much sympathy and empathy I have fits into this topic speaking. So most venture capitalists certainly, they do a quick sort as to good idea, bad idea. So the fact that you're getting these guys, and most of them are investors, you're getting these guys actually giving some counsel is kind of unusual. So don't have that expectation whenever you see it meet. That having been said, I also, if you want to meet out to these folks, anybody in particular, let me know and I'll give you their contact information. But even more important than that is for you to start taking on a philosophy and taking your own initiative to reach out to people. And I'm more than willing to talk to any one of you and give you appropriate contacts. I'm not an industry expert in almost anything. But I do know a lot of these people who come here regularly and can point you to people who can give you good feedback. And then to the point that Russ Siegelman was doing yesterday, doing your primary market research, and we'll hear more about it today from Michael Deering too, is going to be the most important thing that you can do. So, I apologize that we don't have 2, 3, 4, 5 advisory sessions for each of you, but kind of take this as the beginning of you seeking counsel and feedback, not only from investors, but from potential customers, and that becomes part of your norm. So there are a couple new bios in the packet as well. Unfortunately, Brent Knudsen is not coming to do an advisory, and he's sending Trip from his office. And then also, I mentioned yesterday, Don Hutchison is coming, who was an investor in Chris, and Chris mentioned him. And he's also going to be on the panel. I did talk to him on the phone, and yes, he does have a huge laugh. I will confirm Chris's statement. Also, we have, I just found them, copies. We're just about to open Module 2 and Module 3. Module 2 is where you guys have the opportunity to pitch your idea for feedback. That's going to be done by application. It's very short. You shouldn't spend a ton of time on it. But we want that so we can put people in the right buckets and also make sure we don't have anything totally inappropriate. And those applications are actually due on Monday. It's not extremely onerous. I'll email it to you. It's also going to be online. And then Module 3, I have a draft of the agenda, which I handed out to you guys. It's draft. I have not put any meat on the bones. I absolutely positively welcome and need your feedback. So let me know about anything with that. I'm guessing everybody had a hard time walking through parking this morning, so people will be trickling in. That's nice. But Peter Reese is here. Peter is our new faculty director. After I was elated that Garth got named dean, I threw a temper tantrum knowing that he was going to leave CES, and Garth handpicked Peter, and very rightfully so. It's been a huge bonus for us in the CES. He's been teaching formation and new ventures for about 3 or 4 years now 4 years. With Rob Chess. And it's just been a treat having him. He's an economist by training. With a PhD from Yale, right? Okay, see, I'm remembering some of this. So please join me in welcoming Peter.
Thank you. Okay. So good morning. Let me explain what we're going to do for the next hour. I'm the warm-up act for the next 2 panels. The next 2 panels are on funding. One thing about having panels on funding is sometimes it's hard to track what exactly went on. It's hard to, in some sense, get up to speed quickly on what's going on. So the purpose of what I'm going to do for the next hour is I'm going to provide background for what the panelists are going to do. Some of that background may be familiar to you. Some of it may not. Just to give you an idea of what it is we're going to do. I'm going to talk first quite generally about different sources of finance. I tend to be a data person, so I'm actually going to tell you what it is we know about what firms actually do in terms of financing themselves. Then I'm going to turn to sort of talking a little bit about the way that different types of finance are structured. My apologies to Abby. I'm not going to focus so much on funding social ventures as I am going to talk about funding for-profit ventures. I'll talk both about sort of debt financing, equity financing. I'll talk some about grants or non-traditional sources of financing. We'll talk in detail about sort of angel financing, venture financing, bootstrapping, because those are the things that the next two sets of panelists are going to talk about. And it's probably important to have some context for some of the terms, some of the things that they may be talking about. Along the way, I hope you ask questions, particularly if I'm not being clear or I'm presuming something that seems like I shouldn't be presuming. I'm conscious that this could be death by PowerPoint. The point is not to be death by PowerPoint, but for you to literally have a document you can take away so you're not madly scribbling things. You can pay attention to what it is that I'm saying and realize that ex post there'll be a set of slides there and references if you want to go look up things that I'm saying. So I've tried to document within the slides places that you can go look for more information. And then a final thing I'm going to try and do is give you my own take on what would I do in this situation. If I was going to go for this particular financing, what are the big picture things that I would try and remember in terms of being an entrepreneur approaching particularly professional investors for money. Okay, so that's pretty much what I have in mind. Okay, so at a global level, I think it's important to keep in mind that there are basically two sides of the way that most for-profit ventures are going to be financed. It even applies to not-for-profit. There's things like debt or other things, grants, that companies have access to. Those include things like credit card, personal debt, so taking out a second mortgage, grants. It can even be as complicated as leasing deals where companies actually will lease equipment to you basically for free initially and then extract their surplus from you later on. Real estate and law firms also do things like defer bills, and that can be a great source of finance or, if you like, resources to fund your business. On the other side, there's equity. Equity is a particular form of capital or collateral, if you like, that you have to give away. And you want to do that in a way that generates cash. The typical people who are giving you cash for equity are founders, friends and family, angels, venture capital, private equity, corporate. And there's sort of a newer hybrid model, which goes by the name venture incubator or incubators. They tend to be another source of capital, equity capital. And the main question that you might have is, wow, look at all those different things. What should I do? Where should I be getting money from? What is sort of normal practice? What do people do? And the basic rule is, well, you take money where you can get it. But where do people get it? And so the way I want to answer that question is I want to talk about the sort of what I see as the best evidence we have on what's going on, at least the best in terms of the most recent and in some sense the broadest brush picture of this. And it may be of interest to you anyway, just so you can figure out, you're not alone. There was a survey done by the Kauffman Foundation in 2004 where what they did is they randomly sampled 5,000 new enterprises around the United States. And they did this by basically going and finding entities that had filed incorporation documents. And what they are doing is they are following these companies over time. The latest information I have is 2 years beyond, and I chose 2 years simply because that's kind of like the startup phase. And some things to know is that within 2 years, over 1/4 of these had officially folded. They had gone under. However, that probably understates what's actually going on in terms of how many are active, in that over half of these still have no paid employees. So that ought to tell you something. Many of these probably will fail and are going to fail. But in terms of just what they look like, I've provided you some statistics there. The statistics, I think, are somewhat surprising in that most people doing startups haven't done a previous startup. Almost 60% have not done a previous startup. Most are male, but when I show this to people, many are surprised that the number of female entrepreneurs is actually that high. I find it somewhat interesting that this roughly mimics what the mix is in terms of our MBA students recently. Roughly between 30 and 35% of the class is typically women. So I don't know whether this is representative of, for example, MBA students' interests, but it roughly follows along what we see in terms of a mix of an MBA class. Another thing that's quite interesting is that it's not just young people that are starting businesses. In fact, many older people are, and it's quite common actually for people 20 years out to be thinking about starting a business. So 20 years out from school, you see people of 35, 44 year age range being interested in starting businesses. Okay, so that's by way of background. What I think is more interesting is to go back to this question of where are they getting money from in the first 2 years to start a business. So the first experiment or way of thinking about it is to simply ask, if I randomly sampled a firm, so I just went and randomly sampled one of these 5,000 startups that's surviving and looked at their balance sheet, where did they get their money from? Okay? And the answer is overwhelmingly it's bank and other lender debt. And this is not what you would typically hear, I think, probably from the panelists. Most people would not say it's bank debt that people use to actually finance a venture, but actually it's true in the data. You're most likely to see most of the money coming from bank debt. The second major source is owner cash, namely resources that you're putting into the business, your own personal writing a check. There's other informal debt. I'll talk more about that in a little bit. Credit card debt is non-trivial. If you just look at on average, how much money have they gotten from venture firms? The answer is not much. The average, and I'll explain in a moment why it's not much. Another major source is in what I called informal invested cash, but most of that turns out to be angel financing. Friends and family cash, not quite as important as many of the others. Okay, so that's, yeah.
Is that the surviving ones?
That's the surviving ones. So 2 years out, if I just randomly sampled one of these firms, what would I expect in terms of sources? And the answer is debt. Okay? And that's a little bit surprising, but you have to think about it in terms of what I just told you the experiment was. I randomly sampled one. Now what I'm going to do is I'm going to tell you, I'm going to condition on what type of financing you receive. So the thing, for example, about venture financing here is it turns out that most of these companies didn't receive venture financing. In fact, only 0.4%, about 25 firms actually got any venture financing. And when you simply look at, okay, of those that received venture financing, how much did they actually receive? The answer is, well, about $350,000. So venture financing, incredibly important if you can get it, but many firms just don't receive it. The other interesting thing you see now is, well, look at what you see about bank and other lending debt. Much less important now. Why is it much less important? Because many firms can't get a loan. When they do get it, they can get a fair amount, but in terms of the mix, well, they roughly, it looks like many firms are getting it, but they're getting on average about $70,000, $80,000 from the bank. If you look at the informal investor cash, the angel investments, these are the second biggest category right before debt. So this is why I think today you're largely going to focus on venture cash and angel financing, because conditional on getting it, those are the biggest sources of cash for businesses. But again, you should keep in mind that looking at the average business, those two are not incredibly important for the average business that's going to be started up.
Do we know how much the average business is looking for? It seems like that might skew. Maybe a lot of people simply aren't going to.
Well, so this is a point we're going to get into, which is in terms of thinking about these businesses are incredibly heterogeneous. There are probably some iPhone app firms in here, as well as dry cleaning firms, as well as drug firms. And those have very different cash needs. They're going to require very different sources. And so we'll get into talking a little bit about differences in sources. But the thing, in terms of just thinking about the audience here, if I sort of think about, in terms of all the different businesses you might be starting, the point, I think, one of the points I want you to take away from is, there tends to be a tremendous focus on getting venture financing. Most of you are not going to be venture-backed, is my guess. And then the second source is angel financing. And probably a greater fraction of you will get angel financing. But many of you, probably in your first 2 years, are going to be using a credit card to start your business. Or you're going to a bank, and a bank, if you have any sort of collateral, may be giving you a loan. And some of this other informal debt will include things like leasing contracts. And the point I'm trying to make here is most businesses are very creative in terms of source. It's not all venture, it's not all angel funding. And that's the first point I want to leave you with, which is despite the focus of the next two panels, despite the focus of Silicon Valley, firms are using just an amazing variety of things in terms of trying to generate cash. Okay? Okay, so in terms of thinking about this question that Kareem asked, gee, I'm trying to start a business, I get some sense of relative weights of these things, but, ultimately, I'm going to have to think about my business and, what are the cash demands of my business? And I find it quite useful here to break that question into two parts, or what I call two stages. Stage one, as I like to refer to it, is to ask the question, how can I fund the business until I've essentially got a proof of concept, or I can essentially go to these larger sources of finance? So even if you're going to do venture, you've got to make progress typically before a venture firm is going to give you money, before an angel is going to give you money, even before a bank is going to give you money in many cases. So the first problem you have to grapple with is this question of, until I can essentially come up with something I can sell to an external funder, how am I going to finance myself? And that's called the bootstrap phase. That's typically where a lot of these other sources of finance are going to be used. That's where you might go to a bank, you might try to get a leasing contract written for you, you might do friends and family funding, you might just use your credit card or your house to actually finance your business. So the first thing you want to think about in terms of financing is, okay, I'm typically going to have to meet some milestones in order to get money from a professional or an external investor. What are those milestones? How long is it going to take me to achieve them? And let me then back out how much cash, how many resources I'm going to need to get to that point. Okay, so that's the first question. That's the bootstrap phase. We'll talk about that on the next slide. The second thing I like to do then is, okay, assuming we actually get to the point of meeting a milestone, having something that we can actually shop around, a prototype, a draft web page, maybe something, maybe a slide deck that's actually complete that projects a real business concept that an external funder will look at. You want to ask yourself, okay, what's my strategy to actually get the business funded from that point on? And that's typically, am I going to go angel? Am I going to go venture? Am I going to actually try and get a bank to float me a loan? So thinking about it in those two pieces is incredibly important, simply because often you don't have something to sell and you're going to have to basically carry things on your own dime to start. So let's talk a little bit about stage one. Stage one is, well, it's easiest to do if you're rich. So how many people in the room are rich? That's what I thought. Basically, you got to carry things around. I have any number of stories from past MBAs that the way they start their business is on a credit card. So looking for 0% APR, high limits. That used to be popular until about 2 years ago. Now the credit card companies have sort of figured out, gee, I don't want to give 0% APR, and look at all my charge-offs on those entrepreneurs that went under. They're much more sticky about that. So you got to be more clever in terms of thinking about how you're going to get cash, and we'll talk a little bit about that in a bit. The other thing that typically it's going to push you into is thinking about how can I execute without using cash. And that can occur in one of two ways. One is you can actually be pursuing an application. Like, I think this is why iPhone apps are so incredibly popular. I don't need any cash or very little cash, and I can execute quickly. A couple of months, I've got an iPhone app, it's proved out, and then if I need more money, I can get more money. And so you see a lot of people doing this. The thing about that is, well, lots of people can do this. So very competitive business. If it was that easy, I don't need much cash, then you got to think about, can other people replicate what I'm doing? So that's one story. A second story is, well, actually I'm in something that's going to need a lot of cash, but I've got to figure out how I can delay that. How can I make substantive progress without using a lot of cash? And that typically is called bootstrap. It's what you have to do at phase one. You just have to be very creative. You have to get as many resources as you can. We'll talk about that more in a little bit. What are the advantages of bootstrapping? Well, the longer you can do this, the longer you can essentially survive on fumes, the better things are. You retain equity, you retain control of the company. You demonstrate to outside funders that you're creative, that you actually can do things without, without burning cash. And there's nothing that an external funder likes more than to see you don't have really nice office furniture, you've got a beat-up desk, and that's basically it. Cash management, the discipline of having to actually bootstrap something that later funders actually like. The problem with doing a bootstrap, which is not going for money early, is, well, you may not get beyond stage one. Okay. So then there's stage two. There's sort of, now I've got something. I've got an idea, I've got a prototype, I've got a web page that I can show people. I've got something. How do I leverage that? And this is essentially, now you've entered stage two, and there are a couple different sources that you can look at. First, an overlooked one is grants. This applies to the social entrepreneuring context, which is very often foundations will give grants, like the Gates Foundation will give grants for things that particularly are health related or developing country related. But the other thing you should know is the federal government, particularly these days with the stimulus package, has tons of money to give out. Particularly if you have something that's scientific, it's clean tech, it's useful by NASA, the Defense Department, the National Institute of Health. There are basically 12 agencies in the federal government that have what's called an SBIR, a small business grant program, essentially, where you can get what are called phase one or phase two grants. A phase one grant might be for $100,000. Phase two grants on up go for $2 million. The major advantage of getting a grant like that is it's non-dilutive. Okay, if you could get $2 million, and actually I'm talking with a company right now that has just put in an SBIR grant for $2 million. It's a tremendous bonus in terms of making progress. It costs you nothing other than the application process. The downside is, well, there's some probability you might not get it, and if you do get it, sometimes there are limitations on what you can use the funds for. Yes.
What do you find out about those?
So if you want to find out about those, just go to Google, type in SBIR. There's a local office down in San Jose that has a very nice woman who can help you sort of navigate that process. But the main website will tell you about the different programs across the different agencies. Each agency has its own program. So the National Institute of Health, for example, has a different program than NASA, than the Department of Energy, than the Defense Department, and so on. So each department has its own set of rules, but you can basically navigate that just by going to the program that talks about SBIR grants.
What is kind of the time frame of that, like from application to actually knowing it's
Okay.
a multi-month process? Is it
So
a multi-month process?
it varies, but roughly, for example, for an NIH grant right now, there are 2 or 3 funding windows. So there are, I think the most recent one was in April. There'll be another one in the middle of the summer. There'll be another one in the fall. These are points at which you put in a grant. Typically, if you're going to put in a grant, you're going to talk to a grant person in one of these agencies. There's an application process, but there's actually a person who shepherds your grant application process. You put it in, and typically what happens is if you put in for April right now, you will be hearing end of July. Sometimes when you hear it's of the form, we need more information. Sometimes it's, we're going to fund this. Typically, if they do fund a grant, the money will show up within a month or two after they've actually made a funding decision.
So April, think you won't get money until August.
Yeah, but it could be dragged out. I've seen companies be dragged out for a couple of months because there are things in the plan that are not quite clear, or they want to put restrictions on the grant. So 3 to 6 months if things work out well. You can also be turned down. You can be, in some sense, waitlisted. They can tell you to apply again. So it's not a guaranteed thing, but 3 to 6 months roughly is the cycle.
How does the grant process work for private or for-profit companies versus 501c3s?
So that's a more complicated question. The SBIRs have a set of conditions that apply to them. The conditions are, the main conditions are for an SBIR, there are conditions about the percent ownership that the founder has to have. There are conditions on having partners. There are conditions on where the business is located. It has to be U.S. nationals. There are not conditions that I'm aware of on that, for example, the tax status and things like that. It's more, how is it going to be applicable? And
does that apply also to, you mentioned the Gates Foundation earlier?
The Gates Foundation. So the Gates Foundation has a completely different process.
But are they generally able to give grants to for-profit companies?
It depends. I can give you one example. There's a company up in the East Bay called Amyris, which is a biotechnology company. The way Amyris started was it took technology out of Berkeley Labs that was a platform technology, and what they did initially is they went to the Gates Foundation and said, we can use this platform technology to actually produce an anti-malarial drug. So the Gates Foundation gave them many millions of dollars to actually develop that drug. At the same time, the company was actually working on biofuels. So there's an example of a company that actually used a Gates Foundation grant to sort of push along a business, which is now a biofuels company. Along the way, they've developed this artificial anti-malarial drug, but there are strategies like that that can be pursued where actually you take grant money that would normally be a not-for-profit thing. Of course, the money comes with contingencies. You have to work on the anti-malarial, but at the same time, it allowed them to push ahead their technology of developing yeast strains so they could use them in biofuel applications. So with a platform technology, it's not uncommon to sort of see that. It's less common to see a company that's for-profit that has a specific thing that's not really it's a for-profit thing, but getting money from a not-for-profit foundation, that's a little bit less usual.
Are there any particular grants for minority-owned businesses?
Yes, there are tons of them. This doesn't exhaust the list. There are state government grants. Texas and California actually have quite active minority business grant programs. New York State has one that I'm aware of. There may be other states that actually have active programs. It's something you should, the point is, it's something you should go look at. There are, you can get on the web and start searching, and you'll find tons of things. But the main ones to be aware of are the not-for-profit ones, SBIR, STTR, which are the main federal government grants. Okay? Debt. So debt is the other thing that when we looked at it, on average, the average sort of company actually uses debt quite often. Again, the advantage with that is they're borrowing according to a promised payment schedule. Often those payments are deferred in many of the types of debt that we'll see startups using. It's non-dilutive, so that makes it quite popular. In other words, non-dilutive means that you're not giving up equity in your company, share of profits, stock, however you want to think about it. You're simply promising a payment schedule. Now, the way I like to think of this is the way you're going to get debt typically is because you have some sort of collateral to post. What is collateral? Collateral are assets, for example, intellectual property that you could pledge against the debt financing. But equity is in some sense also like debt financing in that there's a collateral. The collateral is the equity in your company, and you're more or less giving out that equity as collateral. The difference really is in terms of thinking about the payment stream and what's promised. So let's talk more about equity, since that's going to be the subject of the panels that are coming. So what are the key sources here? There are angels, and I like to distinguish between angels as individuals and angels as groups. Those are really two different types of funding mechanisms. There are venture capitalists, there's corporate venture capital, there's private equity, and then there are the incubators that I'm talking about. Okay, so roughly how do they differ? Well, at the lower end of the food chain, you have what are called friends and family that provide cash for equity. Typically, friends and family are writing you checks for $10,000, $5,000, maybe up to $100,000. The way that money arrives, or the motivation, is they just believe in you. And that's a great thing. The downside is they believe in you. So I call this dumb money, which is they know nothing about what you're doing. They just look and they say, oh, that's my nephew. I'm going to write a check for that. That's really dumb money. And you want to think very carefully about what that means, which is, suppose you go belly up. Suppose you just fold. Is that going to color the relationship with your friends and family? And the answer is, in many cases, yes. Even though they gave it with this sort of warm personal connection, they don't really know what they're giving it for, I think, in most cases. The advantage, though, is personal connection. There's little to no due diligence. It's the simplest possible money to get in. But on the other hand, I think of it as having major strings attached. Okay, then you can turn the next sort of step up in terms of the amount that you're going to get for this sort of stage 2 financing. So I've got something. I need a lot of money to get it off the ground, is angel financing. So angel financing is kind of a step up from that. And it's a step up in terms of the amount and the amount that the person is removed from you. So an angel is basically a person that has a given net worth. It's actually defined by the SEC, who can be an angel. It's a person with money, and they're going to be giving you a check, which is typically $50,000 to $100,000 per angel. And many companies, if they need lots of money, it's like $1.5 million, are going to be putting together groups of angels. So angel financing is really typically group financing. Sometimes you form the group, and other times you approach a group of angels. So there's a difference there in terms of how you're going to put the money together. But basically, they're wealthy individuals who are going to write you a check for your business. The main way it distinguishes from venture capital is, for the angels, it's their money. Okay? They are writing you a check from their funds. For the venture capitalists, they're writing you a check with somebody else's money. Okay? Somebody else has given them money to invest. And that's the distinction between angel and venture. Often there's very little distinction between the contracts they're going to write you. It's just a difference in some sense of where the money is coming from. And finally, at the other end, not necessarily a step up in terms of an amount, but a very different type of equity financing is strategic investments. That can be corporate venture capital, or it could just be an outright cash investment from a company like a med device company. If you're doing a med device companies are famous for looking around for med device startups to fund, simply because it's a way that they've found over time they can extract intellectual property. And we'll get into that. But basically, it's an alternative source where companies actually are out there looking for technologies that they want to invest in. Tracy?
Do strategic investors typically put clauses about first rights to the
Oh,
product?
they try to sneak in all sorts of things. So it's not uncommon to see, for example, in medical devices, them trying to put in clauses, for example, that we have first rights on the next round of funding, for example, which would be a kind of a closet way of saying, we're not going to let anybody else in if this thing proves out. We're going to be the main source of funds, and then since we're the main source of funds, we can extract terms that are quite favorable to us. We may even have the right to, for example, you can put in a clause that says we have the right to approve who it is that can make an offer to buy you out. And so they can nix deals, which is often a way of just bleeding you to death so that they can buy you. So they're very clever sorts of things that they can do. So it's important just to have this landscape in mind. So angel investors, let's talk about those. Yes, there's a question.
Sorry, I just had a question about friends and family and the strings attached.
Yeah.
Have you ever had people issue stock to friends or family or something so that at least they're getting something in return?
Absolutely.
Taking a bet, you have
Absolutely.
shares,
So
maybe it'll pay off or maybe it'll go bust.
depends on the sophistication of the investor. It depends on the sophistication of the entrepreneur. Sometimes it's a personal loan, but sometimes it's actually an equity contract where you give me $5,000 and I'll promise you X% or so many shares of the company. Typically it's shares, and the family member doesn't know enough to know, well, what does the shares actually represent in terms of fraction of the company, things like that. But very often it's equity. Very often the friends and family don't really care so much as it's an investment in you, and it's up to you in some sense to propose terms that you're comfortable with. Do you want this to be a loan? Do you want it to be equity? That's something to negotiate. The interesting thing is if you're going to take friends and family and then go approach angels or venture, the angels and the venture people will be very interested in what you did with friends and family. Okay? Be aware that as soon as you take money from anybody, it's a promise typically, or the outside investors are going to want to know, is this a promise and what form is the promise to previous investors? And the way you do it can sometimes muck up the deal with later investors. So for example, if for example, in doing friends and family, you actually put a valuation on the company, you'd say, okay, Uncle Pete, I think my venture's worth $5 million. You're going to give me a check for $100,000. That's your fraction of the company. You've already established a valuation on the company, and that's going to be important to investors going forward, because if they're going to put in money, they care about what's essentially the value of the company then. Uncle Pete cares about, well, if you said it was $5 million now, and now you're telling the angels it's only worth $2 million, oh, I don't like that. So you can create conflicts by the way in which you would structure these things. And later investors are going to care about what you've told earlier investors. Okay, so just quickly, angel investors, big source. About 55,000 ventures received angel cash in 2008 in the United States. The average investment is about $350,000. It's not uncommon for that to be about $50,000 from each of 7 investors, although there's nothing special about $50,000. The point is, an angel investment is typically made by a group. A group is going to write, if each person in the group is going to, in some sense, act as in a portfolio fashion, which is they're going to try and find other people to put in money and cobble together the amount that you're looking for. There are a huge number of these people, about 260,000. I've given you a reference there if you want to go read more about angels and the facts. Here's an idea of what sort of sectors they're investing in. I even found this fact. Often women want to know, are there angel investors who are women? And quite surprisingly, there are many angel investors who are women, and women receive roughly the same proportion, or roughly the proportion of angel money that they represent in terms of asks. So again, angels rarely invest alone. There are 2 ways you can go about getting angel funding, and I'll describe the process a little bit more in a minute. But basically, you can go around looking for angels where an angel is a person. And that's what I call ad hoc angel investing, which is basically you're looking for a person who gets excited about what you're doing. But they may not be willing to write you a check for $350,000. They're willing to write you a check for, say, $50,000. And the person you're looking for is a person who can serve as what's called the lead. They are the person who, when they get excited about your idea, are going to go find 5, 10 of their friends to actually do the deal. And what makes that possible is that this person is typically someone who has domain expertise in what it is you're doing. And they are going to go approach other investors who may not have domain expertise, but they know this investor, and they typically form either formal or informal groups where basically they rely on other people to vet deals for them. Not every angel can have domain expertise, for example, in med devices. But for example, if I know Carolyn there, She has a career in med devices. She was a med device executive. I've seen her invest in other med device companies, and she's telling me, you ought to get in on this startup. I may write a check for $50,000. The key thing is I want to find the person who actually can do that. And there are angels who do nothing other than serve as leads. They go out and they find companies in particular space to invest in. Okay, that's the ad hoc way. There are also groups of angels, which is there are certain groups of angels that just say, well, let's just institutionalize this. We all like one another. Let's organize this process where Carolyn does the med devices, Kareem does, clean tech. And what we do is we just meet as a group every month. We look at 5 to 10 companies. Kareem comes in and says, I found this clean tech company. Here it is. I'm going to describe it. Yeah, that sounds interesting. Let's bring them in. So there's actually now a trend towards having groups. I've mentioned 2 here, but there are many groups now where the professional investors have just decided to organize this side of the market. So there are basically 2 ways to approach. You can go to groups. You can go to individuals. Why groups? Well, groups have some advantages. They have some disadvantages. So the advantages of groups are they kind of have this process organized, so they can do this quite quickly. And if you approach a group, you get them interested, typically, angel financing is something that can happen in 3 to 5 months. Okay? Sometimes a little bit quicker. It depends upon what type of diligence process they have. But basically, a group has the advantage that they have a formal process. They are good at doing due diligence, even though they do it by committee. The other advantage to groups is that they often now are conduits for VCs, and that's something to be aware of. For example, if you go to Band of Angels or you go to other groups, they often have informal connections with VCs where they're literally going to be early stage financing, and then they're going to turn around and try and pass off the later stages to a particular VC or a particular set of VC firms. You should explore, if you're thinking about having a group fund you, whether that is actually going to lock you in or steer you towards a particular type of venture capital firm. Okay. The main disadvantage of a group is they tend to do things by committees, and committees aren't necessarily the best form. The other thing is an ad hoc person who actually, for example, has operational experience in what it is you're doing typically makes a much more effective mentor. They can, an individual who's not part of this sort of group looking for a large portfolio of projects to do can spend much more time mentoring you and adding other value than just cash. So that's the way I sort of think of the difference. Okay, there are 2 types of deal terms that angels are going to typically ask for or have. They tend to look very much like what you would see with other types of financing. There's essentially what's called convertible debt, which is a debt instrument initially. It's a loan. The loan comes with an interest rate, although the interest is typically deferred. And the loan converts to equity, that's why it's called convertible debt, at what's called a pre-qualified or a qualified financing. So that would mean the next time you get a substantial amount of money from somebody else, what's going to happen is this debt, so let's say I've given you $500,000, that debt is going to convert to equity in the next round, say a Series A round from a venture capitalist, and the conversion rate is pre-specified. It's pre-specified either by saying, okay, I put $500,000 in, and let's say it's $1 per share at the time of this next financing, I get a discount from that because I was the first money in, or I may get warrants, which are extra shares, and typically the contract will specify, is the qualified financing going to trigger either a discount to the price in the next round, or is it going to give me extra shares in the next round? And some sort of typical ranges are there. The other form is going to look more like venture capital. Sorry.
So when you're seeking funding from friends and family right out of the gate,
yeah, you can offer them convertible debt.
Well, and is that something which would keep your cap table the cleanest if you are expecting to go to the
Yes and no. Typically, the thing is that with friends and family, you can write such a contract. It's not unusual to see such a contract. The thing that can happen both with friends and family and angels is a sophisticated investor in the next round can sometimes just completely undo what it is that you may have contracted over, which is they may come to you and say, you know, your cap table award with that friends and family round where you've offered that warrant coverage, that's just not standard when we do a deal. What we want you to do is go back to your original investors and get rid of the warrants. And you know, if you're kind of running short on cash, you've got only a couple of months to go. If your friends and family or your previous angel investors are kind of sophisticated, they may be thinking, my God, we're going to run out of money here. You're going to go belly up. Maybe we have to get rid of the warrants. And so the thing to be aware of is when you negotiate the terms of the convertible, they're contingent on this next qualified round, and what happens at that qualified round sometimes can completely undo what happened before. With friends and family, it may not be such a big issue. With angel investors, they may be more sympathetic to the way you wrote it. It is easy to understand convertible debt, and so that's not uncommon. It's just there's also room for more opportunism than there is with a preferred share round. So, kind of a trade-off there. So preferred shares, what are those? Well, the difference between this and convertible debt is just an amount of money. We don't need to argue over what is the value of the company, how many shares. So convertible debt's easy. I don't put a value on your company. We don't have to wrangle about that. With preferred shares, we actually have to put a value on the company. We have to say it's worth $1 million or $5 million. And we can argue about that forever. But assuming that we can put a value on it, what's going to happen is the founders are given common stock. The angels or the venture capitalists are given preferred. Preferred means that shares are preferential and they come with certain rights. For example, veto power on what the company can do in terms of future financings or sales of the company, things like that. But at the end of the day, with those two different stock classes, what's going to happen is you're going to get a certain amount of money. Let's say the angels are going to give you $500,000. It's not uncommon for the angels to ask for up to 50% of the company at that point, which is, that may sound like theft, but that's the way it works. And what you're betting on is, even though I only end up with 50% of the company, or maybe even less, that at the end of the day, this thing is going to grow. So even if after I get diluted down, 5 years from now, I may hold 1% of the company, but it's 1% of something very large, as opposed to 50% of something very small. So that's the hope.
Is there an expectation among the angels that they'll get diluted down as well?
Yes, absolutely. And not only that they'll get diluted down, but they're worried if you're going to go do venture later on that they're going to get eaten by the sharks. So one thing to ask the angel panelists in the next session is how do they think about protecting themselves in follow-on rounds. Okay.
Quick question.
Yes.
The reading barely touched on it, but subordinated debt is something that I've come across, especially I think with search funds. Could you just real quickly explain that one?
Well, so I'm not an expert on subordinated debt, but you can actually have debt that, in the same way that you can have a pecking order in terms of common preferred share, you can have debt that has different types of priorities, and depending upon whether that subordinated debt is convertible or not, you can have different types of priorities established in terms of what it's convertible to. Maybe what we can do is just hold this until afterwards, because I think, I'm not going to make much progress. It's a good question, but I think it's more specialized in terms of just thinking about the different types of subordinated debt. Okay, so I'm not going to, I basically repeated this, so let me just give you sort of a summary of thinking about angels. So angels typically invest, 25 to 100,000. It's individual money. That's the main thing to realize. You're getting a check from somebody's bank account. That's different than the venture people. They have quite different motives. Very often, you can have the rich dentist who just, I heard I could make a lot of money writing checks to Stanford MBA students or Stanford students. So that's what I'm going to do. On the other hand, you could have retired executives who know a lot about the space who just want to give back. And that's their motive for writing the check. The money's not so important as they just want to get involved. And so you see everything in between. How do you find them? Well, they can be found through organizations. So you can just Google angel groups and you get Band of Angels, Sand Hill Angels, dozens and dozens of angels. In fact, there's now an angel organization of angel organizations. You can find them by talking to people in the field. So if you're in med devices, for example, there's people will know who are the med device angels. You can talk to Linda. You can network with other GSB or Stanford people. One way that I think is quite popular is you can look at companies that have succeeded and have gone public, for example. You can actually find out the names of the angels, or often the angels will promote, I was an early backer of company X, and that's another good way of finding people who might be angels in the particular space that you're in. Again, if you're doing this not with a group, but individually, you want to find that lead. You don't want to find the dentist. You want to find sort of the person with domain expertise who can sell your enterprise to other angels that they might know. You want to evaluate the angels not just based on what money can they bring, but can they bring other things. Operational experience sometimes is key, so they don't necessarily have domain expertise, but they have operational experience. A lot of times the angels have connections to VCs, and that's very important to ask your angel investors. What VCs do you know? Have you ever had one of your companies that you funded actually funded by a VC organization? Why? Because the angels can be key introducers to the venture capitalists. And that's something you're going to need if you're going to go seek other funding. There's this difference in the type of investment. Usually convertible versus preferred are the most common. The other thing to know is that the due diligence process for angels is not as extreme as I guess that's a good word, as the VCs. So it will take less time to get money from angels than venture capitalists, but you're still looking at 2 to 5 months typically to finalize. And today, you actually probably are looking at a longer process just because of the current funding environment. Okay, I'm going to assume you, from the reading, you know private equity versus venture capital. The thing that I wanted to make clear in this slide is just realize the venture capitalist is actually sitting in between two entities. Institutional investors, these are the people writing the checks, so they would be angel investors, but they don't have the time. Stanford likes to invest in startups, they just don't have the time to do it, so they're going to give money to a venture firm, and the venture firm is then essentially going to act just like the angel group in dealing with a set of portfolio companies. Okay? The critical thing in terms of thinking about venture versus angel is the venture people are using other people's money. And the reason that's important is it gives the venture capitalist very different incentives than the angel investor. What are the different incentives? Well, institutional investors supply venture capitalists with money in what's termed a fund. A fund is the venture capitalist goes out and raises a set of commitments from people like Stanford or the Ohio State pension system. Those might add up to, say, $100 million, $200 million, $1 billion. And that fund lives for a certain number of years. The typical life cycle of a fund is 10 years. So what the venture capitalist is going to do is draw money from the institutional investors over a 10-year period. Typically, the money is drawn very early in that 10-year period. And the hope is that the fund is basically going to be closed out after 10 years. So that says a venture capitalist is looking to return whatever success the portfolio companies are going to generate back to the institutional investors at the end of the fund, 10 years, say. So let's say you get money from a venture capitalist at year 5 in the fund. And let's say down the road, 2 years later, you're doing well, and the venture capitalist is sitting on your board, and an opportunity comes up to buy your company. And let's say you're not so keen on it, you want to keep pushing this thing forward. What do you think the incentives are of the venture capitalists? Well, they might be actually kind of conflicted because they're looking at their watch and going, you know, the fund's got 3 years left and I got to show the money to these people, and I could get my money out now if the company's sold. And that's all driven by the fact that they're not patient because they've gotten the money from somewhere else. And it's important to understand that. While the venture capitalists will say, we're your friend to the portfolio companies, they, and in some sense they are responsible to you as a portfolio company. They do have your interest at heart. You have to also realize they also have somebody else's interest at heart, the institutional partners where they're getting, and they're going to have to raise another fund. And what's critical for them is they got to show returns. So to the extent that there's what's perceived as a dark side of venture capitalists, it comes from this tension. You know, they want you to do well, but they want you to do well because they want to return money back here. And the way that venture capitalists earn money is based on the size of the fund that they earn, or size of the fund they raise. They get a management fee of typically 2%. So if it's a $1 billion fund, 2% of $1 billion, that's just great. How do they raise $1 billion? Well, it's because in the past they've generated returns. And the venture capitalist actually gets carry, which means that after they've returned the original investment, they actually get to keep a share of the profits they generate. So they actually have their own incentive to not just raise large funds, but actually return money. Okay, we're heading down the home stretch. I have about 5 minutes left. So I'm just going to give you a set of advice, facts. These are my observations, if you like, about what you should be thinking about, what you might ask the panelists on the venture capital session about. So I mentioned the funding cycle, that drives behavior. If you're going to get into a VC fund, one of the first things you want to ask the VC is, where are you in your fund? Meaning, you know, how many years in are we? Where's this money going to come from? If they're only 2 years in, that's much better than if they're 7 years in. Why? Because there's just a lot more pressure if they're 7 years in. The thing to note is the VCs promise and expect big returns on their invested capital. What that means is, you know, I've got this $1 billion fund. I don't want to mess around with $50,000. I want to give people $5 million, $10 million. And if I want to invest large chunks like that, you know, if I'm going to get 35 to 50% per year return on that money, you've got to have a business that's both in a growing market and in a huge market. I mean, you've got to be able to generate returns for them, and it's got to be because you can handle $5 million and potentially return $1 billion. Okay, so venture capitalists they don't want to mess around with smaller businesses. They will tell you straight off, your business is too small. It's not going to generate the types of returns that you want. You have to be talking about a blockbuster business in order to get them interested. It's very important. Next thing to know is most VC firms are small. They have 5 to 10 partners. They may have many associates associated with them, so they have more people. But in terms of who are going to make the investment decisions, typically 5 to 10, it could even be 1 to 2 partners are the ones that make all the decisions. On average, partners, especially these days, only invest in 1, maybe 2 companies a year. So if they're going to commit to you, you know, you're talking Sequoia. I talk to people at Sequoia. They're running about 5,000 business plans over the transom each year, and you know, 5 to 10 partners. We're talking at maybe 20 companies that are going to get a real serious look. So just first of all, think about your odds. They're small. And in terms of just the attention you're going to get, these people have the bandwidth to do 1 or 2 deals per year. And the reason is because they are already carrying around 4, 8, sometimes 10 portfolio companies. So you're going to be added to, you know, a list of meetings that they're already going to attend. You're really competing for their time. And because of that, they want huge markets. They want big returns in order for them to allocate what little time they have to seeing you succeed. Okay, often I'm asked, well, you know, how do I find a VC firm? You know, who should I look to? And the best advice I can give here is to realize there are mainly 3 dimensions you can think about. The VC firms differentiate themselves typically by stage of investment. So some specialize in seed investments. Those are smaller company initial investments. Some will only do growing companies, so what are called mature companies. So if you're a startup, you're really at the seed stage, and you go approach a mature company VC, you've just made a huge mistake. They'll tell you, you know, that's a really nice idea, come back in 5 years. You've basically wasted your time. So know early, you know, is the VC I'm approaching appropriate for the stage of investment that I'm at? Second thing is VCs don't do everything. Some specialize down into just clean tech, just med devices, just IT. Some do portfolio, 2 or 3 of these things. it's important to actually look at what the VC is doing and know that it's appropriate, that they actually have people with domain expertise. And finally, location is important. Believe it or not, VCs do not like to travel to meetings. So if you're on the East Coast and they're on the West Coast, that's a big trip for them. You're going to get more attention if you're in Silicon Valley, you have a Silicon Valley VC. If you're in Boston and you have a Boston VC. So location actually can be quite important. One thing that I've heard recommended is if you're going to go look for VC funding, that you actually draw out an array. An array looks as follows: VC firms across the top, companies down the bottom, where the companies are companies that are already in your space, that have received VC funding. And you actually want to map out, has Sequoia actually funded someone in my space before? Why? Well, because that will tell you, A, that they have domain expertise there. The other thing is it will tell you is they have a track record. And they may have a bad track record. And if the partner has a bad track record in this particular space, you don't want to waste your time there, because if they funded a blood immunotherapy company before, or 3 or 4 of them, and they've all gone belly up, don't waste your time. You want to find basically, if you like, a VC that's early in the funding process, that has domain expertise, that has been successful funding companies in the past. You also want to do this map simply because you know whether they have a conflict. VCs will meet with you if only because, well, I've already got a company in that space. I want to see whether Jenny's company has anything interesting that I should tell my other company about. So they do intelligence. They meet with you just simply to see what you're doing, not because there's any realistic chance of funding, and you should be aware of that before you go approach a VC and engage in a meeting with them. You should just do some due diligence on the VC before you actually engage with them. Another piece of advice: VCs do not look at things that come over the transom. I mean, you can just ask them. How do they decide who to look at? It's because somebody calls me, a good friend of mine, maybe a previous entrepreneur I invested in, or an angel I've done business with, or a lawyer, and says, look, I just saw this business plan by Edward. This is really somebody you ought to talk to. And the VC goes, that person, I trust that lawyer's judgment, and I'm going to give Edward time. If Edward just sends in the thing over the transom, even though I may have a website that says send your business plans here, it's not typically going to get any attention at all. You really need to, if you're going to get face time, it's got to be through a connection. What are the typical connections? Having a good lawyer is a great way to get an introduction. Having a lawyer that deals with VCs is probably a prime route. Knowing an entrepreneur who's had a relationship with a particular VC is another great way, because they can vouch for you sometimes. Angels are another mechanism. Basically, you're going to need to find a way in. I had one VC tell me that one clever investor found a way in by finding out that this person was a competitive cycling person, and their cycling group used to meet on the corner of Sand Hill Road in the Alameda every morning, Saturday at 9 o'clock. So what did he do? He bought a bicycle and went out to the road and made the introduction that way. Not necessarily the best way, but you can be creative. Another thing to realize is that VCs are like angels. They syndicate. You will not typically receive just money from one VC in a deal. Typically, 2 or 3 VCs are going to participate in a round. And so what's quite common is when you approach VC firms, you're looking for that lead. You're looking for a VC that says, I believe in what you're doing, and oh, by the way, I think I can get Sequoia or some other firm to follow in on this deal, to kick in half. So that's particularly if you're asking for a lot of money, $5 million, $10 million, that's the way it's going to work. They're typically not going to go in it alone. They're actually going to want to partner on the deal. Another thing to be aware of is negotiating with a VC can sometimes be a long, drawn-out process. They aren't necessarily in a rush. You are. They love to say things like, well, I'd like to see you meet that milestone before I write the check. And they basically want you to wring as much risk out of the business as possible. So you should be aware of that. If you get to the point where they're actually interested in making an investment, they do something called due diligence. It's important for you to understand what that means. It means they're basically going to look at everything about your business. I've listed a bunch of things here. A great bit of advice that I think I could give here is be aware that if you're doing anything right now, document the heck out of it. Because when it comes to an investor doing due diligence, they basically want to see everything. They want to see all employment contracts. They want all the IP documented. If you want to speed up getting money, have this process organized where you can literally hand them the spreadsheets, hand them the employment contracts. You'd be surprised how many companies spend months fumbling around trying to get the lawyers to document the IP. If you have IP, you're developing it with a lawyer right now, make sure it's documented now because it just saves time in terms of having this diligence process work. Okay, almost done. Sometimes it takes a lot of persistence with VCs. You may have to do many pitches. They may put you off. I've often asked, I could talk to a VC now, but it seems a little early for me. Should I talk to a VC? And my attitude is, yeah, you should go talk to the VC. If only because you can give what's called a soft pitch. You can say, look, I'm working on X. We really think it's too early for us. We're trying to meet a certain milestone. Here's the milestone. And then ideally, you know that if we meet that milestone, we're going to need a lot of money. So what you do is you tell them about the milestone before you meet it, and then you go back to them once you've met it. And being able to show progress like that is often a way of making a soft pitch turn into a hard pitch. A lot of people worry about, are they going to steal my idea? My advice there is almost all ideas. If the worry is somebody's going to steal your idea, and that's going to put you at risk, then you're probably, it's all about execution, and you're probably not the right people to do that. I mean, you should be getting your idea out there. If the idea is a good one, you should be the one that can prosecute that idea, or the only one. And the VCs should hopefully recognize that. Finally, term sheets, get a lawyer. That's about the best advice I can say. If you're negotiating with a VC, you want to have your own lawyer. Sometimes they'll offer to give you a lawyer. Don't do that. You want your own lawyer. If you're interested, Fenwick & West is quite active here. I mean, I'm not recommending them as the lawyer. I mean, Wilson Sonsini, lots of other good firms, for example, in Valley. But Fenwick & West does something very useful. They survey deal terms every quarter. They put it up on their website. You can find them quite easily. Just look through it. You can see what types of terms are currently being offered. I could try and do that now, but I really would just pull off their documents and sort of summarize what's there. So this is a very useful place to sort of go and look at what are deal terms currently, what are companies doing. Okay, so that's basically it. I was going to talk a little bit about hybrid seed funding models. If you're interested in sort of incubator models, Y Combinator, that sort of thing, you can come ask me afterwards or on your time. So thank you very much, and I'll stick around and answer questions.